Hey everyone, welcome back to Stablecoins Part 3. We've been looking at stablecoins, what stable money is, where they fit in, the history of money, sound money, all these things, and this is the third episode. If you haven't seen episode 1 and 2, make sure you go back and watch those. In episodes 1 and 2, we covered several things about stablecoins. We went back to the history of money, and we talked about how money actually communicates value. All right, that's what money is. So it's important to understand that. We talked about how stable money is key to having free markets. Really, in order for our economy to thrive, we need to have a stable money, a store of value. We talked about the 4 functions of money, what money actually is, how it works, how it goes from a collectible all the way up to a store of value, what those stages are. We talked about stablecoins themselves. What are crypto stablecoins? And then we talked about how the different types of stablecoins work, how there's really 3 types of crypto stablecoins that we're looking at. So that's what we've covered in 1 and 2. If you haven't seen those, go back and watch those episodes, and we'll get right into the final and third episode on stablecoins. All right, guys, so the 3 types of crypto stablecoins, or really there's 3 basic categories we can put them into. And the first type is like an IOU. It's an issued, it's asset backed, it's collateralized. And that's a good example of that is Tether. That means that for every one Tether that's out there, there's supposed to be collateral or an asset backing that as well. So there's an asset to back up the coin. So that's the first type. The second type is what we call collateralized or crypto collateralized. So instead of putting up US dollars to collateral or any type of other asset, you're putting up cryptocurrencies to collateralize that. And the third and final type or category of stablecoin, crypto stablecoin, is what we call a non-collateralized or a seigniorage share. So those are the 3 types, lots and lots of stablecoin projects that fit into each of those projects. But I just wanted to cover that again real quick. We went deeper into that last episode, but I want to go deeper into that because we're going to look at projects that fit into each of those categories. So of course we can't cover all of them, but we'll look at some that go into each category. So the first and most popular stablecoin, the one you've probably used if you've used any at all, or at least you've heard of, or you've seen in the exchange, if you've seen USDT, that's Tether's US dollar, they're tethered. And just like the name implies, they're tethered or pegged to a US dollar. So that is a collateral-based stablecoin. That's where that fits into the bucket. And it is supposed to be a 1-to-1 ratio backed by US dollars. So that means for every $1 of Tether USDT that's out there in the world, there's supposed to be $1 of USD sitting into a escrow account. Now, Tether has been around the longest. It's actually on one of the oldest blockchains that's out there. It's been around since 2015. And since then, the price has stayed pretty stable. It's gone from a range of about 91 cents up to $1.21. So it does have a little bit of fluctuation, but compared to what we've seen Bitcoin or Ethereum or some of these other cryptocurrencies do in that same time frame, it's been really, really stable. Now, it is backed by Bitfinex, which means it's centrally controlled. Now, obviously, it doesn't really fit into the whole narrative of what Bitcoin and what cryptocurrencies are. We're trying to be decentralized. We're trying to take away third-party counterparty risk. So this is a third party. It does provide counterparty risk. It is centrally controlled. The problem with Tether is that there are no third party audits. So there is no like big 4 accounting firm that's gone in there and audited that they actually have the dollars backing up how much they say they have. So this has created a lot of controversy. We've seen reports come out where people are saying that it's not backed. There are not enough dollars to back up the USDTs, that Bitfinex keeps printing tethers just to prop up the price of Bitcoin. There's been lots of FUD. I've seen some really good evidence to back that up. I've also seen evidence to show that it's not the case. Bitfinex did go out and hire a law firm to say that they did have the backing. However, it's not really acceptable. We need a a financial firm to go in and audit, so they haven't provided that yet. However, it is the most widely used. It is on pretty much every exchange, most major exchanges you can use it, and you are able to convert it into dollars, but only on Bitfinex. So if you're using it on Bittrex or Binance or whatever, you can go into USDT and then back into crypto. But if you actually want to get fiat back into US dollars, you have to go into Bitfinex and pass their KYC and so forth. Now the next one is the same. It's True USD, and it's the same type. It fits into the same bucket. It's a collateralized. It's also collateral backed, again, 1-to-1 with the US dollar. It's only been around for most of 2018, since about March of 18, and the price has fluctuated from about 97 cents to $1.03. So really stable inside that small range. Of course, it's only been out since March of 2018. Now, this is a little bit different, where it's actually built on the Ethereum blockchain. So it's an ERC20 token. As I talked about with Tether, it's on its own blockchain. And so it's not ERC20. Now, ERC20, if you don't know what that is, it's built on Ethereum standard, which means it can go into pretty much any wallet. So what I like about TrueUSD is I could go from my crypto into TrueUSD, basically like going into dollars, and then I could take it off of the exchange. I don't like to keep my coins on the exchange because that's counterparty risk. It creates risk. If something happens to the exchange, they go down, they get hacked, they freeze my account, whatever, my funds are at risk. So I always want to get my money off of there, and so TrueUSD allows me to pull those coins off and put them into any Ethereum-based wallet, my Ether wallet, something like that, your hardware wallets with Trezor or Ledger, etc. Also, it's not decentralized. Again, it's centrally controlled, just like Tether is. However, they are publicly audited. They use a smart contract to manage the amount of collateral that they have with the amount of tokens that are out there, and it is audited by a third-party company. It is on most of the major exchanges. You can find it on Bittrex and these big exchanges, and you can convert directly back to USD through TrueUSD. So they use a third party to do that. So they kind of use like an escrow service. So it removes the counterparty risk because now you're using a trusted third party, more or less. I would prefer to take those back. But if you do want to exchange them for dollars, they'll do that for you. So again, that's a collateral backed one. Now we'll go into a different type and we'll look at, this one is a crypto collateralized. Now this is MakerDAO. This one is built on the Ethereum blockchain, and it's an amazing experiment. They've done really, really well. They're storing a lot of money on the Ethereum blockchain, helping Ethereum to really grow into a kind of a reserve currency status. Now, this one is a neat experiment because it is decentralized. So this is running autonomously. It is decentralized. It is collateral based, just like TrueUSD and Tether's. However, instead of being pegged to dollars or being collateralized by dollars, it's actually collateralized by crypto. So that's the second category, crypto collateralized. So what it does is it uses Ethereum to stabilize its prices. Now, Ethereum is not very stable. Right, it's gone from what, 1,400 down to 200 just this year alone, so it's not very stable. So what they do is they do a 1 to 1.5 ratio of collateralization. So that means for every $100 I want to borrow, I have to put up $150. So I have to put up $150 to borrow 100. So that it's not what we call collateral efficient. That means I have to put up more money than I'm borrowing. So it's not efficiently using that money. It's been online since the end of last year, December 2017. Their price range has remained relatively stable compared to what Ethereum's done. It's gone from about 85 cents up to $1.62. Now, that's not as stable compared to TrueUSD or USDT. However, compared to Ethereum, it is pretty stable. What I like about what they're doing, one, it's just a really cool project to see it kind of as an experiment and see it kind of play out. But they're using smart contracts to manage all this. So you're not trusting a centralized third party. So it definitely takes that piece out, which is a big problem for me. I don't like having a centralized person controlling that. So you get the smart contracts to do that. It's decentralized. Now, it's not widely accepted. You're not going to find it on any of the major exchanges, but a lot of the smaller exchanges that do the ERC20 type tokens, you will see it on there. And in order to get your money back, you're going to have to return the DAI. So if I borrow 100 DAI, that's what they call the individual tokens, I have to pay them back, and then I'll get back my Ethereum or whatever it was that I put up as collateral. So that's the second category, crypto collateralized. And then the third type of stablecoin is a non-collateralized stablecoin, and this one's very interesting. Basically, you're not putting up any collateral, so it's basically like a fiat currency, meaning it's just been created out of nothing and there's really nothing backing it. The other two had dollars backing it or had crypto backing it, but this one has nothing, has nothing backing it. And what they're doing is they're pegging to US dollars. So this one we're talking about a non-collateralized is called Basis. It was formerly called Basecoin. Now they've changed their name to Basis. And basically it's pegged to the US dollar. So one Basis coin is equal to one US dollar. However, they use two other tokens in order to keep the price stable at $1. So it's pretty interesting. That could probably go into a whole video on its own. I'm not going to do that, but it kind of works like the Federal Reserve. So the Federal Reserve is responsible for inflating and deflating the monetary supply to keep the interest rates in check. And so what they do is they issue more tokens or issue debt against those tokens. So the way it works is if the price of the token gets over $1, which would be good if you're an investor, but as a stablecoin, you want it to be stable at $1. So if it goes above $1, what they'll do is they'll issue more Basis coins, they'll inflate it to bring the value down. That's what happens to your dollars, right? As more dollars get created, it brings the value of those dollars down, and that's exactly what Basis does, is they produce more Basis coins, create more Basis coins, and it brings the price or the value of the Basis coins down. Now, if it happens in the opposite direction where the price of the Basis coin drops below $1, what they do is they issue bonds against it or debt against it. It's kind of like an option or a piece of debt, right? So they'll issue bond tokens. So they have Basis tokens, which are creating inflation, and they airdrop those out to the Basis token holders. Or if the price goes down, they'll issue bond tokens to these people. And that's the way they're trying to do that. So they're trying to artificially manufacture or manipulate the price. And right now it's theoretical. That's what they're planning to do. It's not launched yet. They have raised $133 million from some of the biggest venture capital funds that are out there. And so by no means is this decentralized. So it's going to be centrally controlled, and it's experiment. It's one that I don't think has a good chance of success, but I'm definitely interested to keep an eye on it. And it's not the only one doing this. So this is the non-collateralized type. So that's the three types that we talked about. Now, there's lots and lots of stablecoins. So it would take tons of videos to get through them all. So I really wanted to give you the understanding or the knowledge of the three types, so you can start to see when you look at a stablecoin, where does this fit in and which ones do I like? You have to understand that there's all types of trade-offs. There's a couple other ones that are honorable mentions. Haven Protocol. I like that one because it is crypto collateralized. So again, it gives us the decentralization. And also this one has privacy built in. So it's kind of like a privacy coin. And that could be really good for, there's trillions of dollars, I think estimated over like $30 trillion parked in offshore bank accounts that are basically hidden, right? And so those types of people could put money into this because it could be a stable coin that wouldn't be moving around, and it's decentralized, not to worry about it getting taken, seized, stolen, and it's private so nobody could see that. So it's a crypto collateralized one. There's also another one called Globecoin. And what I like about Globecoin is a very interesting project is they peg it to fiat, but instead of just pegging it to the dollar, what they do is they peg it to a basket of currencies. So they take 15 currencies and then they use it in the ratio in how dominant they are across the globe. And so that's supposed to create more stability, because now instead of just pegging to one that could go up and down, now they're pegging to this basket of currencies, which is a pretty good experiment. I like that. Obviously, just pegging to one currency, you're only going to be as good as that one currency. If that currency goes up and down, then your peg goes up and down. Now, the dollar is the world reserve currency. That's why people are pegging to that. But this one, the Globecoin, 15 different currencies, pretty interesting. And then the third one that's honorable mention is this DigiX Gold, DGX. And what I like about that is, as we talked about in series 1, how gold has been the main store of value for over 5,000 years. And what they're doing is basically they create an ERC20 token, so an Ethereum standard token, and it's backed by gold, physical gold, and it's publicly audited, and they've just basically tokenized physical gold. So by buying this stable coin, I actually own gold. One DigiX token is equal to like 1 ounce of gold, or gram of gold. I'm sorry, I forgot which one, gram or ounce of gold, but it's backed by physical gold. and it maintains the peg to gold. So if gold goes up, it's going to go up, and if gold goes down, it goes down. But gold's been pretty stable. It's been in the 1200 range for several years now. So those are a couple more stable coins, honorable mentions, just because they're unique in the way that they're pegging or finding their value. Now, I want to just talk real quickly about a little piece of history. You know that I love history. I really use history to kind of help us tell and predict the future. So history shows us that trying to peg coins, trying to manufacture the value of coins fails. Value is found between us when we conduct trade, when we transact. That's how value is found. You can't just artificially manufacture it. That's what, unfortunately, many governments have tried this. It's always failed. This is also like wage controls, price controls. They try to artificially set the price on products, things like that. It never works. And pegging currencies to create a value has never worked. The most famous one, or maybe the most disastrous one, was called Black Wednesday. And the history of this is where George Soros, if you've heard that name before, George Soros was put on the map. Now, George Soros means a lot of things to a lot of people. I'm not going to get into all that. However, this day put him on the map. It was Black Wednesday, and really you have to kind of go back to see the history unfold in this. So in 1979, in Europe, all the different countries in Europe had different currencies. And so doing trade was difficult. Imagine in the United States if every state had its own currency, how difficult that could be to conduct trade if you're traveling or buying stuff, online, which they didn't have at that time, but it would be difficult. So what they wanted to do in 1979 is create this ERM, this exchange rate mechanism, where basically all the countries could come up with a ratio that their currency should be pegged by, and they could have this exchange rate. So that'd make it really easy to use. So it was supposed to lower the variability, make it easier for trade, for exchange. And so in 1990, Britain decided to join that. Now, it didn't go easy. There's a long history with that. Britain did not want to get in, as you can see, from 1979 to 1990, so over 10 years. Britain didn't want to get in. It required an entire change of their leadership. Finally, they got in. And Britain was supposed to keep their pound within about a 6% variable to the other currencies that were out there. That's the agreement. So they have to keep it within that 6% range. Now what happened is things weren't that good. Inflation was running high, and their mechanism, the way they were tied to this ERM was bad. It was a bad deal that they got into. The economy was bad. It wasn't working out. And George Soros has this fund called the Quantum Fund. He realized this, and he thought that it was unstable and that it was probably going to fail. So what he started doing was piling on shorts, and he piled on shorts, waiting for it to fall. Then he started dumping shares on the market, and he started dumping a mass amount of shares on the market. The Quantum Fund did, and then all types of other investors and speculators started dumping their shares on the market. Britain started trying to buy them all back, and they were buying them back as fast as they can. They were trying to get all the investors to hold them. They started raising interest rates, promising to pay higher and higher interest from 10%, 12%, 15%. If you hold these, we'll pay you 15%. But it didn't work. People were just dumping them too fast, and then it failed. The peg failed. George Soros made over $1 billion, 1 billion pounds in one day when that peg failed. It was massive. It was called Black Wednesday, as you can see in this slide. It made newspapers all over the world, and Britain lost its peg. So that's one example. It's a famous example. It's happened many times before that, but interesting piece of history on that. So we went over this in in series 2, but this is basically the trade-off of these types of coins. We have fiat collateralized, which we talked about, which was Tether and True USD. We have crypto collateralized like MakerDAO, and we have non-collateralized like basis coins. And they're better and worse for different things. The fiat collateralized are secure to crashes because they're pegged to a dollar. So as long as the dollar is good, they're going to be good. The problem that I don't like is that they're not decentralized. They're centrally controlled, which means they're open for manipulation, which is maybe the case going on with Tether. I don't know. It hasn't been proven. And they are collaterally efficient because it's only a 1-to-1 ratio. So that's okay. The crypto collateralized, I like it better because it's decentralized. However, it's not secure to crashes. Crypto's super volatile. So if it's pegged to crypto and crypto's volatile, then it's going to be volatile as well. So I don't like that. And it's not collateral efficient because I have to put up 150 just to get 100 back. So it is good for decentralization, but the other two factors, it fails. Now the non-collateralized, like the basis coin, it's not secure to crashes. It can be decentralized because it can be automatically adjusting the inflation level, and it can be collateral efficient because there is no collateral at all. So you have to understand those. Now, each one of them can have a different use case depending on what you're looking for. But to sum it up and give you my thoughts on it, we need stable money. We need to have stable money. As I showed in the first episode, the dollar has not been stable, right? The dollar has lost over 90% of its purchasing power. Now, you live and breathe in the dollar, whatever dollar country you're in, but that doesn't mean it's stable. We've lost 90, in the United States, the USD has lost 90% of its purchasing power. All right, so we need stable money in order to have free trade, in order to have a good economy. That's an SOV, a store of value. Now, stablecoins could be it or maybe not. I believe that by pegging to another asset, by pegging to an unstable asset, doesn't make you stable. So if you peg to the dollar, you're stable against the dollar, but you're not stable to something else. If you would have pegged to the Venezuelan dollar, your stablecoin would be worth nothing. So it's only as good as what it's pegged to. I also believe that manufacturing stability, it's never going to work. History shows us that. I gave you an example of Black Wednesday. So you can't manufacture stability. I believe that the market is going to have to sort itself out. As I went over in slide 1, there's kind of that history of money. And as it gets bigger, as it gets more adoption, as it gets more use, it will find more stability naturally. You can't manufacture it. You have to understand that with stable coins, there's always going to be trade-offs, like I just talked about in the slide before. It's either going to be secure or not, decentralized or not decentralized. It's going to be collateral efficient or not. And so you're just going to have to weigh each one and see where you fit in. Now, what do I think about these things overall? Now, I use stable coins. I think there's definitely a use for them. I envision that at some point, Bitcoin, Ethereum, maybe some other ones will become the massive store of value, and stablecoins won't be really as necessary, but that could be a really long time from now. So what do we do now today? If I need to move into dollars to get away from crypto volatility, let's say that I'm a trader or I'm an investor either way, and I'm in a crypto position, I'm in Bitcoin, it's at $20,000, I think the market's gonna crash tomorrow and I wanna get out. But how do I get into dollars that quick? Maybe Coinbase doesn't, I'm past my weekly limit or whatever, or I have to go through several steps to get it to Coinbase. So what I can do is I can just go straight to USDT or True USD. And by doing that, I'm out of crypto and I'm essentially in the dollar. Then when I see the market's right, I can go right from that tethered coin or the True USD and right back into crypto again. So it's really good for quick, short moves if I want to get out of crypto into dollars and from dollars back into crypto. So I think for short periods of time, it can be very useful. For long periods of time, I would probably just go ahead and put your money right back into dollars because at least with the dollar, you know what you get. In the bank, it's FDIC insured. With Tether, like I said, there's arguments to say that it's not backed and it could collapse, and there's arguments to say it's good, but that's risk. There's risk that you're taking, and with any of these coins, there's risk that you're taking because they're centrally controlled. So I might be better off just with dollars that's FDIC insured. So I think it's useful in matter of trading, going in and out of positions quickly. Over long periods of time, I probably wouldn't be storing my money there. There are some interesting projects that I'm watching, like the gold-backed one. I like gold. I own gold, both gold stocks. I own physical gold. And so having a stable coin backed by physical gold makes sense for me, so I'll keep my eye on that. But that's how they work. Hopefully that makes sense for you, and hopefully you've got something good out of this. Now, as always, I do this for the likes on the videos. Make sure you're giving me likes. Make sure you're subscribing to the channel, and I always reply to every comment. So leave me comments. Let me know what your history is with stablecoins, what your experience has been, if you like them, if you don't, what kind of questions you have, I'll get back to you. Make sure you like the video. Please subscribe, share it, and that's it. To your success.